Hello and welcome to this very special show of Hot Commodities. I am Manisha Gupta and the top headlines on the show are: straight up, the competitive devaluation of the currencies makes a comeback. China devalues yuan by a record 1.9%. All Asian currencies react to the Chinese yuan devaluation, hit multi-year lows. The Singapore dollar is at a 5-year low, while the South Korean won also hit a 3-year low in the intraday market. And the Indian rupee hits a 2-month lows at 64.27, ends the day at 64.21 to the greenback. Well, the Chinese government has made a significant change in currency controls. The People's Bank of China has allowed the yuan to depreciate almost 2% against the US dollar to levels last witnessed 3 years ago. While the move has shocked currency markets across the world, a devalued currency is sure to boost foreign trade by making China's exports cheaper. Remember, this swift action by the PBOC is post-weakening trade data from the world's second largest economy. To discuss more on the impact of this move across global currency markets and on India as well, we have with us a very special panel. We are joined by Sharmila Whelan, who is Deputy Chief Economist at Asianomic Group, along with Ananth Narayan, who is co-head of Wholesale Banking South Asia at Standard Chartered Bank. We also are joined by Manoj, Rane, who is MD and Head Global Markets and Treasury at BNP Paribas. Sharmila, hi, let's start with you first. And is the Chinese devaluing the yuan a start of currency wars? Is competitive devaluation of currencies back?
Yes, in effect, the Chinese yuan real effective exchange rate, it's appreciated by 14% since June last year. This, together with the weakness of global demand, is hitting Chinese exports at a time when the Chinese domestic economy is slowing very, very rapidly. Now, what we've seen with the 1.9% devaluation is an attempt to reset the yuan and also to lock in retail investors in China. But clearly, it's not enough. How the Chinese authorities proceed from here will be interesting to watch. They've got the SDR discussion with the IMF coming up in October. So it's very difficult to see another devaluation before that. But I think what is more interesting is that now the new fixing will be based on the previous day's market close rather than the previous day's official setting. To me, that talk speaks of creeping depreciation of the yuan.
Manoj, this question is to you. We, of course, woke up to quite a bit of a surprise and a big one at that coming in from China. What are your initial readings to it? And would you say it's enough that the China really seems to be doing now, especially on currency as well?
I think there are several factors which probably caused this to happen. You know, without looking merely at the extent of the depreciation or the depreciation itself, the fact is that they are moving more to a market determined rate, because it will be based on a pole of the market, number one. Number two, I think it's also in the background of the very stringent measures which they had put into the stock markets about a month ago, which had actually shaken up the confidence of a lot of investors. So from that point of view, I think it is more to give a bit of a positive sentiment into market players that here we are moving to a market determined kind of scenario. There were also question marks on their inclusion in the SDR, the Chinese currency, primarily stemming from the very strong measures that they had introduced. So they're hoping possibly that moving to a market determined rate might make their task a little more positive than what it looked like about a month ago. And I think more importantly, it's also based on the way the economy has been going. The fact that exports have sharply decelerated. In fact, they are in negative zone as far as growth is concerned. They have a 6% positive growth target, but they are at minus 0.8 or something last month. So the point is that they do need to encourage exports back, and what better way than to have a slightly weaker currency from where it has been. So I think that has played an important part. Also, Manisha, I think another thing to remember is that in terms of their economy, the industrial sector has been really racking up negative growth, and that's really worrying them. Services sector has been positive, But the fact that industrial growth has been negative, and also, China's entire story has been on the manufacturing side. So I think that's one of the reasons also which has possibly played a part in this. Just that, of course, the timing was not expected at all by anyone, and the fact that it has happened took everyone by surprise. So I think these are a whole set of reasons why possibly this has happened.
Well, absolutely. The shaky equity markets, the high local debt, and of course, as we were talking about, low manufacturing, the credit growth, the services growth, all of those numbers have come in weaker from China. But Ananth, the Chinese central government is calling it a one-off. Do you really believe that, or do you think the currency really has much more way to getting devalued from these current levels?
Hi Manisha, I think we'll know a little more immediately tomorrow. The market will watch tomorrow's fixing with some interest. There were of course confusing signals which came out from the PBOC today. They did specifically say this was a one-off. At the same time, they also said that they would reference the previous day's market close, which by the way today has moved up to the 6.325 range today. So it'll be very interesting to see right away tomorrow as to what the fixing comes at. I suspect, as do most market participants, that we won't see a big change tomorrow. Having said that, the market will factor in that this is the start of a process. The forward points for Chinese yuan have already moved up, indicating that the market expects more depreciation to come through. And frankly, from a China perspective, as everybody has stated, I think it makes a lot of sense. This is not the start of a currency war. This is more like China responding to what's happened over the last 2 years. If you see, even today, since May 2013, when the first taper tantrum shook the world, the Chinese yuan had been, till today morning, one of the best performing currencies in the globe. It's strengthened significantly. In RER terms, it's overvalued significantly in the last 2 years. And what China is doing right now is playing a bit of catch up in the backdrop of negative export growth, in the backdrop of significant capital outflows in the last few months and weeks. In fact, in the last 1 year, their FX reserves are down by $350 billion, which is a significant number. So it ties up a lot of points. Yes, we were not expecting a move right away, given that there was talk of SDR move and all of that, which we thought would mean stability. But clearly, this is a move which is a reaction to what's happened in terms of dollar strength, and will have ramifications for the rest of the currencies, given the size, the sheer size of the Chinese trade machine. 10% of global trade is coming out of China. It will definitely have an impact on the rest of the world.
We clearly have seen that coming in today as well. There has been a knee-jerk reaction across board, not so much in equities, but the Asian currencies, the emerging market currencies definitely took a hit there. This one is to you, Sharmila. We've seen Asian currencies like a rupiah or a ringgit decline very sharply, trading at the lowest level in 17 years. Of course, there have been other many factors as well, but today the decline in these couple of currencies was the most.
Yes, I do. I mean, if we get creeping depreciation of the yuan, Asian currencies are going to come under pressure, particularly commodity exporters that have been geared into the China growth story. And here we're talking about the Malaysian ringgit and the Indonesian rupiah. Because if you look at Asia this year, Asian exporters are struggling. Asian exports have, in US dollar terms, have been flatlining since early 2011. Things are worse this year, thanks to QE out of Japan and out of the Europe, weak global demand, as I mentioned before, a slowing Chinese economy, and the collapse in commodity prices. And already Asian exporters have been cutting prices very aggressively. Now you've got, the Chinese changing their exchange rate policy. This is only going to add to the woes of other Asian exporters. So it stands to reason that Asian currencies will continue to come under pressure.
Well, absolutely. And the other few currencies that also saw sharp declines was a Singapore dollar, a Thai baht. All of them actually slipped nearly a percentage point as a knee-jerk reaction. We are looking at a multi-year lows when it comes to most of them. Manoj, what is your sense? Is it a chain reaction? Is it a one-off? Is it one day? Or as everybody is saying, especially Ananth also put out that it would be interesting to see how we see the opening tomorrow, and that is where we would take further cues from.
I think it's important to look at the Indian context as well when you ask this question, and the fact that the currencies which have depreciated the most are really commodity currencies, and and there is not much you don't have to look far to see the reason. Most commodity indices are at lows prior to 2009. So the point is that effectively even the crisis did not see the commodities being as low as they are today. So the fact is that all commodity exporting countries are going to see a lot of pressure on their currencies, which is actually in a way good for India, because we are, if anything, we are not a commodity exporter. So there is one positive there. But what it means is that it will present a new challenge to policymakers. The fact is that on almost every single benchmark, look at an REER or an NEER, export weighted, trade weighted, etc., the INR currently is quite strong, and I think it is indeed concerning policymakers. We had a couple of statements today as well from policymakers and the government as well, from the ministry as well, to the effect that we need the currency to weaken a bit in order for exports to remain competitive. Exports have really taken a beating over the last few months, and there is no end in sight, because on its own steam the currency doesn't look like it's going to weaken substantially from here. And from that point of view, I would and I've always said this, that it's possibly better in India to have a weaker rather than a stronger INR vis-a-vis the USD particularly, which continues to be our principal trading partner. So I think from that point of view, unfortunately we might not see the weakness that is long awaited, and I think policymakers probably would cheer or at least support in the foreseeable future. You have seen a little bit of a sell-off today, but it's still around that 64 level. I'd be very surprised if it gets substantially weaker from here.
All right, Sharmila, what's your sense? How much is India expected to react to China changes in policies? We clearly haven't seen the end of it.
Sure. I mean, India, we're very positive about India. China is today where India was about 3-4 years ago. India, is the deleveraging cycle phase of the business cycle is over. There's signs of economic growth stabilizing. So, India is less exposed. But what we do hope is that the RBI will cut interest rates more aggressively now, particularly as they're already behind the curve.
Ananth, what is your sense to it? There have been various fears on how India perhaps will react to it. One, as Sharmila said, perhaps the RBI governor is behind the curve. Do you see an interest rate cut coming in quite soon now? And also there have been these concerns about higher exports coming in from China, India being less competitive and all of that.
I think if you put everything together, Manisha, the reality is India is in a sweet spot. Unlike the rest of the world, including China, which is facing deflation, which is facing worries about growth, India, being a commodity importer, actually is in a sweet spot when it comes to energy prices, for instance. Clearly a huge positive for us. But in many ways, what the rupee is going through right now is somewhat similar to what the Chinese yuan has been going through in the last couple of years. Today, once after this Chinese yuan move has happened, the rupee has been the best performing currency since May of 2013. If you ignore Argentina, we are by far the best total return performing currency in the last 2 years. Now, that means that, as Manoj said and as the other speaker said, from an RER perspective, we are overvalued, right? So we are already 11 to 12% overvalued. There needs to be a depreciation which comes through, but there is no immediate trigger to see how the depreciation comes through. Unlike China, India is still seeing capital inflows come through in the form of robust FDI. Unlike China, we are seeing our reserves at all-time highs, not at levels which are dipping from the last 1 year or so. So clearly the flow context still indicates that rupee will be relatively stable compared to the other currencies. Having said that, it's not a good place to be in if the currency remains stable, because you have increasing complacency and it will impact our export competitiveness. Already with other currencies having moved so far and now China playing catch up as well, in the long run it will be very bad news for us, particularly with Make in India and all of that, if we have a fundamental lack of competitiveness on the currency. So I agree with Manoj. I think we need to depreciate, at least gently if not dramatically. A move to 65 would be welcome. Having said that, the immediate triggers for that are not visible. We are not seeing any large outflows come through as yet. Today's reaction was, I guess, knee-jerk in that sense. What we have to wait and see is, do we see this following through? Do we see some importer hedging coming through? We know we have unhedged foreign currency exposures in the market. Do people use this opportunity to buy some dollars and become a little more safe in that sense? Do we see RBI staying away from a move of rupee depreciation and allowing it to depreciate a little bit? I think that will be a great outcome to happen. And I also agree that given the global context of disinflation and given the deflation which will come in with a weakening yuan as well, all the more reason for the RBI to take a more sanguine view about global inflation and local inflation, and therefore clear the decks for more rate cuts. Given the context of slow domestic investment environment and a currency which is overvalued, I think there are strong arguments that present themselves for lower rates in India.
Clearly, and perhaps this is the right time that the RBI governor could actually go ahead and do all of that. Let's get in one more view then, and we are now joined by Callum Henderson, who's Global Head of Forex Research at Standard Chartered Singapore, and he joins us as well. Callum, hi, good to have you. What's your sense about India really? Because today, of course, we've nearly declined by a 2-month lows in sense of currency. We actually closed at the lower point of the day. We saw a sell-off coming in for equities as well. But would you call it a knee-jerk reaction, or do you think India actually stands to gain much more from what happened in China today?
Again, our focus is on whether an economy is externally or domestically driven. And given that India is effectively domestically driven relative to the external side, we think that the Indian rupee will be relatively resilient compared to more externally focused economies and economies that are more vulnerable to a CNY move. So INR resilience in the face of depreciation pressures both in Japan and also in Korea.
Quite clearly. Callum, also when we talk about China, the commodities aren't far away, because while we started the day on a positive note for most of these commodities, post the devaluation, we did see commodity prices also give up those gains, whether it was the base metal sector or energy as well. What kind of an impact do you see coming in on that one going ahead?
Well, certainly the underlying bias of commodities has been negative for many weeks now. Our view is that eventually the global economy will resuscitate itself heading into year end. It's taking a lot longer than I think many people expected. We also think that the Federal Reserve will continue with its plans for liftoff from September. So while you see the short-term knee-jerk market reaction in terms of commodities or rates or FX, again, it's important to focus on the underlying fundamentals. That remains supportive for the dollar for the time being. It also short-term negative for Asian currencies, but again, within Asia itself, there's significant divergence.
One more question, Callum, and China really seems to be doing a lot. We've seen a move coming in on interest rate from them. There have been other various stimulus or monetary measures that they have been doing, and now we've seen a currency devaluation as well. What really seems to be working for them, or doesn't, or what should they really be doing?
Well, from our perspective, the key problem with China was that monetary conditions were far too tight, not just in terms of the exchange rate, but also, more importantly, in terms of interest rates, that the local government debt swap has helped to bring interest rates down, that they cut policy interest rates, that they cut the RRR, reserve requirements ratio. So that can fall further. We expect further RRR cuts to improve the liquidity and capital flow situation, and eventually some degree of rebalancing and stabilization in the economy. We're not there yet, clearly, but 6-12 months down the road, where China should look better than it does now.
Fair point, Callum. We'll let you go at that. Thank you so much for joining us with your sense on what really can be expected from China. And of course, today has been a day of a lot of volatility, especially when it comes to the currency space across globe, which have reacted to what China did in the morning today. Manoj, coming to you, what's your sense really on how India could actually be standing and taking an advantage from, because commodity prices declining, monsoon has worked well. What really China has done also, as Ananth was pointing out, perhaps puts India in a sweet spot, maybe enables us to do more here.
No, certainly. I think, as Ananth said and the other panelists also highlighted, this probably makes it easier for RBI to consider rate action downwards in the foreseeable future. Certainly, commodities contribute a fairly significant part of the inflation dynamic. Of course, rains are a factor, but they haven't really been that much to worry about in terms of how much they are lacking. So I do think it creates room for RBI to ease probably earlier and more. Of course, that wasn't something which could have been predicted 2 weeks ago. But the fact that the commodity spiral has remained downwards, and the fact that China has devalued give more room for that to happen. Also, I think the governor articulated during the monetary policy that one of the reasons for the cut was, of course, to keep the currency competitive, or that he would certainly look at that as a factor. So I do think that this puts us in a better position to look at slightly more ambient interest rates going forward. On the currency side, of course, Manisha, as I said earlier, my own view is that we are not going to see the currency weaken in a hurry. The fact is that the current account will remain better and go forward better and better. And of course, capital flows continue to be strong. I don't see that really changing despite all the political uncertainties as far as some key legislations are concerned. It would have possibly seen the currency strengthen far more than it has if those legislations had gone through. But given that the political question marks still remain, I do not see the currency strengthen or weaken substantially from here. So I think we have to be resigned to a 64 and thereabouts kind of range for the time being.
Well, absolutely. The Parliament session has been a complete washout, but can't say that about the international cues because they continue to be on the moving side there. Let's get you one more voice, and joining us now is Nick Parsons, who is Head of Market Strategy, National Australia Bank, and he joins us in London. Nick, hi, good to see you. The Asian currencies have seen sharp declines. That is where they have shut shop as well. What's your sense? What is your sense going ahead now? As per everybody else, are you calling it a knee-jerk reaction, or are you calling it a more prominent trend that we might see emerging now?
It won't make a great deal of difference in the great scheme of things. 2% on or off a currency is not a make or break situation by any means. We don't have to go back very far to remember when these were simply normal day-to-day swings. So 2% isn't going to make a great deal of difference in and of itself, but to the extent that it complements existing policy measures, those such as interest rate reductions, more fiscal easing, more liberalisation of the banking system, of the market for CDs, the extent to which banks can compete with funds and all the rest of it, it's certainly helpful, even though of itself it's perhaps not dramatic. What it does do most certainly is, I think, focus attention back on the fact that the Chinese economy has been slowing down, and slowing down, it seems, quite sharply indeed, and that the authorities are still very keen to make supporting measures wherever they can.
Fair point, Nick. Just enough time to get in one final comment from Ananth. Then would want to put you sector per sector, Ananth, because I was reading a report that e-commerce perhaps in India will do well with what the Chinese have done with their currency, not so much for textile, rubber, steel. I mean, these are the sectors that might see a bit of a hit coming in.
Absolutely. Some of these sectors like steel, for instance, are already having a lot of issues of excess exports coming through, or other imports coming through. And that has not helped any deal by the move in the currency today on Chinese yuan. Look, the reality is a move of this kind in Chinese yuan, if it is followed up with more, would mean exporting of deflation to the world. Now, in a sense, it's good news for India because we are, consumers of commodities, and that does help at a fundamental sense. At the same time, if we remain the outperformer in terms of currency, and even if the Chinese yuan also moves away, breaks ranks from us, and goes on the path of comparative devaluation, it's not good news for us from manufacturing at all. And for that matter, even services. At some stage, we will find competing services from the Philippines, from the rest of Southeast Asia, which will be to our detriment. So I think while it's a positive for us in the current global context, the currency will have a medium-term role to play as far as visions of growing the domestic economy, about regaining export competitiveness is concerned. Sure. It's not as if our exports are in great shape, and we need the export-led manufacturing and domestic manufacturing to pick up to solve all of our myriad local problems. So in that context, I think important for the currency to also move at some stage. I do agree that the immediate triggers are not available, but we are hoping that at some stage hedging does come through and therefore weaken the rupee.
So both sides to the coin, but as of now, we perhaps seem to be sitting on more positives than negatives, as our expert panel is pointing out at. But with that, Manoj, Ananth and Sharmila, will let you go. Thank you so much for coming by. Really appreciate your time in explaining what China really means as an impact to India. With that, completely out of time. Thank you so much for watching.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.